Apple is putting the finishing touches on a service that will let consumers pay for an Apple Pay purchase in installments over time, which is a direct foray really into the buy now, pay later market where key players like PayPal, Klarna, Zip, and Afterpay have truly dominated. This new Apple service will be backed by Goldman Sachs as the lender for the loans that actually support the underlying installments. This new buy now, pay later scheme could further drive and entrench Apple Pay adoption and domination. Even more importantly, it's likely to influence more consumers to use their iPhone or Apple devices to pay for items instead of standard credit cards. And this is a huge shift since some recent studies out of the UK estimate that buy now, pay later took a 20% chunk out of the credit card market during the 2020 Christmas shopping season. These are big numbers. And as I understand it, when a consumer makes a purchase via Apple Pay on any Apple device, they're going to have the option to pay for it in 4 interest-free payments made every 2 weeks, or they can spread the payments across many more months, but they'll have to pay interest on that. Now, consumers are going to be able to choose any credit card to make their repayments over time, which means it adds another at least 30 days to the equation in terms of interest-free periods. Now, you might be asking yourself, why is this so significant? Well, that would be a great question because we already have several buy now, pay later schemes that have really embedded themselves in the retail landscape. But Apple's announcement isn't significant because of its direct impact on buy now, pay later, right? It's significant because it proves that the structures of banking and financing are fundamentally shifting and changing. This week alone, we saw irrefutable evidence that banking as we know it is dying and that rigid foundations that have really propped up these banks and financial institutions are no longer as rigid as many of us might have counted on or expected. The recent acquisition of Afterpay is a prime example of this, right? Afterpay has never made a profit, right? Or cash flow. Afterpay has no history of paying dividends to shareholders and has less than $1 billion in net assets on its balance sheet. And yet, somehow, it was acquired for an implied $39 billion valuation by Square, with the Afterpay shareholders set to pocket Square shares instead of cash. And those Square shares are aggressively priced at 120 times their forward earnings, right? So off the back of this, I want to bring Kane Jackson onto the show. He's our expert this week. Kane is the founder and CEO of Maslow, a financial services startup with a goal to rebuild consumer banking and finance on a platform of inclusivity and alignment with the consumers it serves and has at times previously taken for granted. Maslow has the backing of a number of significant investors, including the ex-CEO of PwC and the Carlton Football Club president. Previous to Maslow, Kane was responsible for registering Australia's first derivative fund and is astutely aware of the significant responsibilities that come with offering a retail finances services product. Kane, welcome to the show.
Rondalyn, how are you going?
Hey, I'm excellent. Hey, were you surprised about the recent acquisition of Afterpay by Square? And had you heard any, rumblings in the market about it?
I mean, I wasn't surprised in terms of timing. I hadn't heard anything in the space around, them shopping around for potential acquisition targets, buyers. But I think in terms of where the market's going, they're seeing increase in bad debts. They're seeing decrease in growth rates. So in terms of the timing, I think it was perfect for them. Whether or not Square was, something I would have considered as a potential suitor, probably not. In reality.
Who did you think it might be?
I would have said one of the larger consumer banks in the US would have been interested. The buy now, pay later space has taken a lot out of the traditional short-term credit market. And I think the banks would want to recapture that, but apparently not.
Yeah. Did you think the banks were ever really under any extreme pressure from these buy now, pay later schemes? And if so or not, why?
Yeah, look, I think I can split that question into two parts. And for me, it comes down to traditionally, the banks provide credit to people that pass their credit tests, and because buy now pay later isn't regulated credit, they don't have to meet those same standards of lending. They were going for a market that the banks weren't necessarily going for all the time, and so in sort of that sense, I don't see there was any true competition being put to the banks by the buy now pay laters. However, if you look at how quickly they adopted and acquired customers or users, that's got to scare any large company, bank or otherwise, in terms of if that company can later convert those customers to products that are more or more closely in their own backyard, then that's something to be concerned about in terms of competition.
What's your sense of it though? Because this sort of buy now, pay later is it's a distinct beast. The target market is very specific and particular. How likely, are these people to have been upsold into different products by either the schemes or by the banks if they had done it themselves?
Yeah, look, the assumption was always that Afterpay would round up these customers or convert them into more traditional financial services customers, and they partnered with Westpac, obviously, to that end. But the likelihood of them doing that, so far as I'm concerned, was always quite low. These are customers that were more comfortable dealing with Afterpay as a feature or a provider of a technical product rather than a banking or a financial services product. And I think the assumption that they were going to be able to convert, these 16 million customers they had into being, lucrative traditional banking customers just wasn't realistic.
And it's fascinating, isn't it? Because Afterpay and ZipPay, when you talk about removing friction in financial services, they weren't exactly stellar examples, were they?
No, and I think that's one of the crucial differences between where the buy now, pay later sort of add-on companies, I consider them, like your Afterpays and your Zips and the many others, differ from what Apple's now doing. Apple is really removing that friction point at the checkout, be it online or otherwise, in person, probably more significantly, the physical checkout. But it's removing that element rather than adding it. If you were to buy with Afterpay, it's an extra step, it's an extra API, it's an extra login. If you buy with Apple, we're all used to tapping our card. We've all set up our wallets already. We click the side button, it looks at our face, and all of a sudden we're there, we've done it. And they've removed that friction point, whereas Afterpay never had that ability to just essentially turn on a feature within their existing technical product that had mass adoption in a market.
No, fair enough. And look, to be fair, Afterpay's primary upside was the frequency of turning the credit around, right? It wasn't really necessarily what they made on a per transaction basis. It was the fact that the frequency of the credit was quite high.
Yeah, the way they used their balance sheet was probably the most attractive part of their business model. Essentially they were rotating that credit and earning their 6% from the merchant every time it was used, despite only having to borrow it once or twice, because it was paid off within an 8-week period.
The banking industry has really, let's be honest, been pretty much protected from fundamental change for decades, right? How does this impact the way that traditional banks are and are likely to continue to respond to the changes that we're now seeing?
Yeah, I think for quite some time, up until quite recently even, the banks had really taken this position that, look, innovation was going to happen in this space, but they weren't overly concerned about it. And certainly a year or two ago, there was not a lot happening with the banks in terms of partnerships. They weren't worried about their moats being threatened. But I think looking at how quickly Afterpay acquires customers, and whilst it might not be in the banking space directly, it is in the financial services space. And so that sale to Square with, on the back of that partnership with Westpac, that's got to hurt the banks. Westpac took a leap and said, okay, look, let's do this partnership with this fintech that we don't want to have to admit is a viable threat, but obviously is. And then they've been relegated to, essentially take a back seat to this sale. And I think if anything else, they're going to start looking around saying, well, we have to do these partnerships, but who are we going to have to do them with? And how are we going to ensure that we get something out of it as well? And I think Westpac would be sitting there right now wondering what quite happened.
Yeah, fair enough. Well, it's interesting, right? Because the banks primarily, let's be honest, make their money from residential mortgages. They're not really, they're not really focusing on business lending or even consumer lending in any major way because the lion's share of the revenue comes from residential mortgages. So this represents a total shift in the way that they look at their customers and maximizing their share of wallet, doesn't it?
Yeah, I think they're starting to see that the traditional ways that they would go about acquiring a customer and then the life cycle of that customer and the products that they could expose them to is changing. And they're seeing that if they don't capture that customer up front and sort of stimulate the relationship, they're not going to get those mortgages. But also, as we know, I mean, the younger generations are looking at home ownership as less and less of a default. And even those that are looking for more alternative sources of finance, like Athena, for example, who are really undermining the bank's margins and promoting a different kind of relationship with customers. So I think the banks are looking at, their traditional revenue base and then sort of looking at the way the tech companies are innovating and really starting to get quite worried about it.
You know what I find fascinating is the amount of brand loyalty and excitement that there is from consumers, regardless of whether a lot of them are defaulting or not, for these products like ZipPay and Afterpay. And then you contrast that with the global market perception that people have of the banks. It's fascinating, isn't it?
Yeah, and I mean, I think I'm looking at something at the moment around what I believe will be the next successful sort of fintech companies or tech companies in the finance space, and I think they'll do one or two things. They'll completely move banking to the rear of a person's mind and the transaction itself, or they'll move banking over to a place where they're handing control of it back to people, and I think that we see that in some of the sort of the DeFi principles, but people aren't as supportive of banks because I don't know that people these days really understand what banks do for them in their day-to-day life.
Yeah, fair enough. Well, look, I think a lot of people begrudge the bank, right? It's a relationship that they've had to have in the past, but they're not necessarily happy about it.
Yeah, certainly. And I mean, if you look at the average, let's say your average sort of 22, 23-year-old banking customer these days, they might use a fair bit of the buy now, pay later offerings, and they deposit their wage or their salary into their bank, but all their banks are doing is really providing them a place to put that money and then spend it from. I think it's a fairly valid question for them to ask, what is my bank actually doing for me? And then, if they don't answer that in the affirmative, then to look for other solutions. And that's, I think, where the banks are starting to get concerned.
Yeah. Given that we're now seeing this kind of like virtual explosion in the area of financial products and services that are largely unregulated, what does this actually mean for the small businesses and also for the consumers? And is it a good thing?
Look, I think it's exciting for consumers, and I think it is going to herald a time of innovation and change, or a pace that we haven't yet seen. But obviously, that brings with it its challenges. No one's sure how much you can lend to people without checking their credit worthiness, and it pushes the onus so far back onto the consumer, who has traditionally been quite protected when it comes to the kinds of credit that they can have access to, and that concerns me. It's always concerned me, and I think we need to start looking at ways to regulate the new entrants in this space to a standard that still protects consumers whilst not sort of impacting on the innovation we're seeing. Because I think that is one of the best parts of what's going on at the moment.
What do you think? What do you think we could extract from buy now, pay later and use to create something that is safer for consumers, but also a bit more fair to the retailers in terms of the price points? Because we're talking rates of 3 times what Visa and MasterCard were charging them to facilitate transactions.
I think from my perspective, one of the things buy now, pay later has proven is that the financial services industry, banking largely, hasn't really seen any innovative change to the underlying products that are offered or the way that they're offered. And whilst buy now, pay later, depending on how you look at it, might be considered a digital version of lay-by, where you get the product up front, what it did was it was the first real change to what was a traditional product suite offered by the banks in the credit cards. And buy now, pay later came along, and people who didn't want those traditional products because for whatever reason they were unattractive or they were scary, it offered them an outlet for that exploration of new things in this space, and I think that sets an incredible precedent. But in terms of fairness, as we said before, we're sort of delving into an unregulated space, and it certainly, in terms of fairness to merchants, 6% versus 2%. Well, it's chalk and cheese. But if you look at natural market forces, PayPal came along and we're going to charge 2% to the merchant. So I think it will self-regulate to some point. I just think we need to make sure the consumers are protected.
What I find interesting about all of this is that if you look back, sort of several decades ago when credit cards were first introduced, one of the things that happened is we moved from a culture where people saved and then purchased things to a culture where we were, it's more like immediate gratification. We need to have it now. We can't afford it now, so we put it on a credit card. And what we started to see is that people were gradually living more and more beyond their means.
It has, and I think for me, one of the questions, and I don't know that I have the answers to it, but one of the questions I ask is how can we look at these changing societal behaviours in terms of instant gratification, but look to use them to empower a positive behaviour and decisions rather than what can be used to target it, and Afterpay and the buy now pay laters did that quite well, was target that instant gratification that the younger generations or even society as a whole is seeking. But there has to be ways to use those behavioural traits for good and not just for sort of risky behaviour.
It'd be interesting if we could take the best of the features of buy now, pay later and use it to somehow incentivize people to save for their retirement or save for a home, if that's on their radar or something that they want to do. Like, that would be fascinating to me.
Yeah, I agree. I think we will see some more businesses come out of that space. I spoke the other day with Matt Home at UPay, and UPay have built a platform for checkout, which essentially allows people to ask someone else to pay, whether that's, you as a 14-year-old asking your mum to buy you a pair of shoes, or whether it's you asking your partner to buy you a birthday present, whatever it might be. Instead of defaulting to a credit purchase at checkout, UPay allow you to spend your own money, or if you can't, or if you're asking someone who would normally give you permission and they don't give you permission, well, sorry, you can't buy those pair of shoes. And I think there needs to be that added element of behavioral change into possible products, but we're people and we don't like being told no, and so that's where the challenge lies.
What do you think are the core elements of this new Apple offering that really make it a much more serious threat to the banks?
For me, it's the removal from the conscious consideration process of a consumer in terms of what a bank does. At the moment, when I tap my phone, my Commonwealth Bank card or whoever I bank with comes up, and I'm still seeing that that's my bank and that's who I still transfer money from and all those sorts of things. And, people in the payment space will argue that there will always be a bank involved, and I probably agree with them. However, what Apple's doing is making banking a feature. And many people have spoken about the significance of that, but Afterpay was an extra layer and Zip is an extra layer, but Apple's removing that layer. And so it's conditioning us to think less about our bank and our relationship with our bank, and that can't be a positive thing for banks in any way.
Do you think it's possible that it's even riskier because there was that extra layer with ZipPay and Afterpay? Do you think that it gave people to some extent a bit of pause for concern before they made the purchases? Or do you think that it's possible that Apple Pay will result in even a more significant uplift in spending, that largely discretionary spending that people can't, necessarily afford?
Yeah, look, I think it'll be interesting to see. I think Apple certainly has more of a tendency to look towards the well-being of its customers than perhaps a new buy now pay later entrant is going to. I think one of the issues you had with purchasing through a buy now pay later at checkout is you process the transaction and they don't tell you how much you owe with them, and you don't see how much you owe with other buy now pay laters, and so all of a sudden you can't really have an overview of your credit snapshot. And I think if Apple removes that layer, I think they certainly have a responsibility to make sure that at that time people are informed enough to make a decision that's relative and in their best nature. In their best interests.
You know, one of the things that I think is really interesting about this is we are seeing a lot of innovation come from people who have operated, for the most part, within the financial services industry for their whole career. But that's not the case with you. Do you think your bank background in having, psychology, health services, even being in the Australian Army, do you think all of that stuff sort of allows you to bring a fresh perspective and a broader understanding of human experience to the topics and the challenges?
Yeah, look, I think the platform I come from is very different. I deal quite closely with people who have spent their entire careers in financial services, and these are people who are guided by basically being told no most of their careers. No, you can't build a product this way. No, you can't do this. No, we can't do it that way. That's because that's the way we do it. And not having that background, yes, it presents problems in that I've got to make sure that I take advice on the complexities and the compliance issues relative to operating retail financial services. But it certainly means that I push a little bit harder on saying, well, why do we have to do it that way? And I think we're seeing more of that in the space. And, the most innovative things I'm seeing coming into financial services are actually being led from people that are more of a tech background or more of a humanistic approach, rather than this sort of compliance-focused, structured, siloed industry of very little change.
What do you see on the horizon? Do you see regulation or do you see innovation being the core drivers going forward?
I think we will see innovation, and I don't think we will see too much regulation until we get to a point where the roles that banks play in society and the broader economic stability of countries, until those things are under threat, I don't think we'll see significant regulation. But the moment they are at risk, the moment that the strengths of the banks are undermined by changes in this space and the economics of banking and finance as a whole, I think we'll see some pretty rapid regulation start to affect what we can and can't do.
Are you aware of any really interesting innovations that are on the horizon?
If you have a look at some of the decentralized finance principles, DeFi as a category is very left of center, very to the mainstream. It's very tinfoil hat, but it does have a lot of themes in it that I think if applied within the constraints of the traditional finance system, have a lot of potential. Peer-to-peer lending, when done right, has incredible benefits. Sharia compliant banking, where no one is charged an interest rate. There are some really interesting things that are starting to be explored more on the back of this movement that's come from society away from traditional things, but in a way that sort of fits within the system that we do have. And I think some interesting things are going to start popping up in the next couple of years.
Fair enough. Hey, thank you so much for stopping by and sharing your thoughts on these, what I think are, crucial topics that we should really be exploring in our industry. If people want to get in touch with you, they want to know more about what you do, what's the best way for them to do that, Kane?
Yeah, look, the best way is probably just to head to my LinkedIn, look at Kane Jackson, and sort of go from there.
Yeah, fair enough. Thank you so much. And I look forward to revisiting this topic with you in the next few months and seeing how things unfold.
Thank you so much.